Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. We can make a lot of money in real estate, but we can also pay a lot of taxes. Today on the show, we're going to show you how you can increase cash flow and reduce taxes with investment real estate. And we've got a great guest on the Real Estate Guys radio show.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, it's our co-host and financial strategist, Russell Gray.
Hey, Robert.
Lots of different ways to make money in real estate. There's the obvious way, when there's cash flow coming into your pocket. Every month, the tenant pays the rent, whether it's commercial, industrial, residential. You pay all the expenses, including the mortgage, and there's money left over. That's cash flow. That's not the only way we make money in real estate. We make money as a property appreciates over time. Now, that gain, if you will, that equity is locked into the property until you do something with it, either refinance it, pledge it, or sell. Then, of course, we have the benefit of amortizing a loan, which doesn't sound like a big benefit, but every month when you make your mortgage payment, part of it goes to pay interest, a big part of it at first, and then part of it goes to pay the principal. That principal pay down means you own more of the property. So that's also a way we make money in real estate. And then the one we're going to talk about the most today are the tax benefits. CPA Tom Wheelwright has taught us that if you want to know what a particular nation wants its citizens to do with their invested capital, just look to the tax code. And the tax code is a series of incentives. Wherever we look in the world, and we're now in more than 190 countries with the Real Estate Guys radio program, there are almost always incentives given to real estate investors to invest in real estate, and it's going to benefit their bottom line, not just from appreciation and income and cash flow, but from the tax advantages.
Yeah, when you think about it, those 4 ways that you rattled off, Robert, with respect to how you make money in real estate, 2 affect the balance sheet. They're going to increase your asset value, which is appreciation, or they're going to decrease your liability, the mortgage, which would be amortization. And the other 2 affect your profit and loss, your cash flow statement, if you will. So, obviously the operations of the property, managing income over expenses, those are the obvious things. But there are these tax incentives that exist that can really enhance your cash flow. And that's particularly important when you just think about the process of going through and acquiring a piece of real estate. You've got some upfront expenses. You've got your due diligence expense, and it takes time to find the deal and underwrite the deal. And then when you do the deal, you have transactional expenses. And if the property you're buying as an income property is not rented or is not optimally rented, then it's going to be underperforming on the revenue category in the beginning, and you've got some work to do. And so during that period of time where you're fixing whatever it is that needs to be fixed, and when you think about rehabbing a property, a lot of people think of physically rehabbing the structure. It's called a physical rehab. But a lot of income property investing is a financial rehab where you're going to go in and you're going to fix the financials. Maybe you got lazy landlord syndrome and the person who owns the property just hasn't been paying attention to it. There's a lot of that going on in certain niches where mom and pops are at the end of their ownership life, and they really don't care. Then you've got people that are, incompetent. You get some of that out there. You get neighborhoods that are going through some type of a transition, and you can catch something on the upswing. But for whatever reason, when you acquire that property, those early years, and you don't know where the bodies are buried and where the cash calls are going to come, those early years can be difficult from a cash flow perspective. And so you need a little help. And the tax code actually provides some help for you in those early years above and beyond what you get over the life of the property. And to understand that is really important, because just because something exists in the tax code to help you doesn't mean it will unless you're aware it's there and you avail yourself of it, not just by claiming it, but by taking the actions necessary to actually put yourself in a position to be eligible. So it is a little bit of a complex topic, but the bigger you get in real estate investing, the bigger the numbers get, the more the return on the time invested in understanding how to play the tax side of the game of real estate investing, the higher the return on that investment of time becomes.
So we've said the word tax enough so far in this program that we should point out that we're not tax advisors or tax professionals. What we give you is ideas and information. You're going to get a lot of those today. And a lot of real estate investors are interested in the property. They're interested in fixing it up from the rehab standpoint you mentioned in the construction, and then fixing up the financial metrics, doing that kind of rehab. They're interested in getting the occupancy, all those things. And sometimes tax is left off to the side. So the first thing we're going to say is that's not the way to do this the best. You want to make sure that you have an awareness and understanding of tax. You're not going to probably do your own taxes, especially when you get to a certain level of proficiency and asset accumulation in real estate. But you're going to want to make sure you have a tax professional that truly understands this. And I don't just mean book smart. I love to see when tax professionals own property themselves. Then they really get it. Now they're trained and they're going to look at what comes out every year and the changes. And we've had some pretty sweeping tax change in the last few years. And because of that, it's even more important that you get a great tax professional. But it starts with you and understanding the basics. And we're not here really to talk about the basics of taxation, other than to understand that, first of all, we rarely let the tax tail wag the investment dog. We're not going to invest in something just because of a tax benefit. Rather, we're going to find a great market, a great property, a great niche, and then we're going to seek to exploit the tax law legally in our favor to the best degree we can. And there's lots of tools for that. And here's a really important part of the message. How well you do in terms of saving taxes is up to you and your tax professional. Two different owners owning comparable buildings side by side, built by the same folks at the same time with the same tenant mix, can have drastically different tax ramifications because of their knowledge. And it's up to you as the taxpayer to know or be aware of or find the benefits that you can use. Today, we're going to talk about a tax benefit that most multifamily and seasoned long-term developers and investors know, but many smaller investors haven't yet found out about. And it's not that it's a big secret, it's just that it takes a certain level of play before it becomes necessary. So to start, just understand that the rough knowledge of taxation is up to you, whether you're interested in it or not.
Yeah, I think what's really important is that as an investor, not just a real estate investor, any type of investor, is like being a CEO. And a CEO isn't going to know how to operate the copy machine, or maybe even, operate the email or reboot the computer or operate the machinery on the factory floor or whatever business they're in. But they've got to be conversant to be able to talk to the technicians who know how to do the work. They've got to have good mid-level management, people that are paying attention. So again, as a CEO of your real estate investing empire, one of the things you do, like Warren Buffett, who spends 80% of his time reading, is you learn to become extremely conversant in technical topics so that you can know when you need to call in a technical expert and get technical advice, technical support. Just throwing back a little bit, Robert, to your comment about CPAs, which I think is an excellent one. One of the things that we say when you're going out there and you're looking and you're interviewing for technical providers, you're looking for people to put on your team, is you want to find out, obviously, if they own investment real estate themselves, because if they're playing the same game you're playing, they're going to pay attention to the same things that concern you at a much higher level. And so we think that's really, really important. But number two is, what percentage of their practice is dedicated to serving clients who are like you are? And that's also really, really important, because just because someone's a CPA and they have access to the CPA books and they have an attorney they can call and ask questions, if they don't deal with it day in and day out, then you lose a little bit of the leverage, you lose a little bit of the speed, you lose a little bit of the tribal knowledge that you get that they're picking up as they're flitting across different clients and solving different tax problems for other people. You may have to pay a little bit more to be working with someone who really knows what they're doing. But in the end, you end up being able to move quicker, get better advice faster, and you get a little bit of wisdom because they're seeing things that are happening at other levels. That's true for all people on your team. It doesn't necessarily have to be just people, like CPAs. Even when it comes to tax, there are subcategories of people who support real estate investors in the tax category that aren't CPAs either. 1031 exchange intermediaries. They know a lot about the tax law. They can't give you tax advice, but they can point you in the right direction. We're going to talk to a guy today who is very experienced in a very specific segment of the tax code, but not a CPA. And these are the people you end up doing business with and talking with, but you want to vet everything that's going on through CPA. So it truly is a team. You're the captain of the team. You're the head coach. It's your responsibility to be able to talk with your coaches and your players. And that's what today's about, is just getting you up to speed on one of the most powerful areas of the tax code available to real estate investors today.
There's two parts of taxation. There is the property, and the property's got certain elements. It's got things like income. It has things like depreciation, and there's elements of the property. Then there's you and how your financial makeup shows up. If you're a W-2 employee, that's different than if you're an entrepreneur. That's different if you have primarily dividend income. So we don't know enough about you as a passive listener to be able to talk about that. But we can talk about what the general tax benefits are of investing in real estate, and that's what we're going to do with our guest. When we come back, you're going to meet Eric Oliver. We're going to talk about cost segregation today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you want to learn how you could potentially increase your net worth by over $1 million and quit your job in just a few short years, listen closely for the next 60 seconds. This is Brad Sumrock, and over the past 16 years, I've helped thousands of people invest profitably in real estate, but not just any type of real estate. I specialize in helping people syndicate large apartment buildings so that they can be business owners and investors. In today's competitive environment, it's even more important than ever to leverage an experienced mentor, invest in your education, and have a team of advisors that has established relationships nationwide. And so many people right now seem to be struggling to find deals and then get them funded, but yet Sumrock students are thriving in today's marketplace. We've purchased nearly 7,000 units and nearly $1.5 billion in purchase volume over the past 12 months. And with the new Trump tax laws, apartment investors are positioned now better than ever before to pay even less in taxes. To find out more, send an email to apartmentsnow@realestateguysradio.com and you'll get my recent presentation called Why Apartments Now. That's apartmentsnow@realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Hi, this is Simon Black from SovereignMan.com, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com and all of your favorite podcast outlets. We got podcast listeners all over the world. It's crazy stuff. Hey, we're talking today about reducing your taxes, increasing your cash flow, cool stuff when it comes to real estate, and it takes a little bit of planning, a little bit of knowledge. And so today, we've got a great guest that's going to help us understand one of the ways that we can approach real estate, specific real estate, to save a lot of taxes, and that's cost segregation. Let's please say hello to Eric Oliver. Hey, Eric.
Hey, Robert. How are you? Hello, Russ.
It's good to have you on the program. We talk every now and then about cost segregation. At many of our live events, we certainly talk about cost segregation, but I can't remember a time in these 23 years that we've actually done a show on this topic. So let's start with the big picture. When we say cost segregation, what is that all about, Eric?
Yeah, so cost segregation simply is accelerated depreciation. So a lot of us get into real estate in order to take advantage of the depreciation laws. And so rather than, as most of you guys know, we depreciate our real estate over either 27 and a half years for residential properties or 39 years for commercial properties. And so what cost segregation is rather than taking basically 1/39th of your depreciation each year, we come in with we do an engineering-based study, and we will accelerate that depreciation. And so the way that works is we will identify the different components of your building and basically segregate out those components into shorter asset lives. So the IRS, for example, allows you to depreciate carpet over 5 years. So rather than having that lumped together with your 39-year asset, cost segregation will come in, identify the carpet, put a value to that carpet, and allow you to depreciate it over a much shorter time frame.
Yeah, and it's fascinating. We're going to get a little bit into the weeds about this because it's an important part of understanding how to speed up or accelerate that depreciation that we get. I think, most people understand that depreciation is on the portion of the real property that can be depreciated. Land does not wear out. That's the theory. It doesn't become worth less. It becomes worth more over time, but land is not depreciable. Things like improvements to the land, curbs and gutters and that kind of stuff, maybe, but certainly not the land itself, but the improvements thereon. Think of a house or a building or a bowling alley, whatever were the improvements, that part's depreciated. And the two categories you talked about are really residential or non-residential. So residential property is generally over that 27 and a half year period. Those deductions that we get to take 1/27 and a half every year, or for commercial property, 39 years. What accelerating that does is give us more tax benefit sooner.
That's exactly right. So when you think about, let's just put some numbers to it. If you think about a simple example, you've got a $270,000 duplex. You're basically going to get a $10,000 write-off every year against your income for the next 27 and a half years. That's without doing cost segregation. Now, if you were to do cost segregation on that same $270,000 duplex, all of a sudden, we're going to identify roughly around 30% of that 270 and categorize that into either 5, 7, or 15-year property. Now, depending on when you bought that and what the laws were at the time, you may be able to write off all the 5, 7, and 15-year property in year one. So again, you're talking 30% of 270. If I do some quick math, that's over $70,000 of write-off in the first year, versus if you didn't do cost segregation, you'd have that $10,000 write-off. And so you can see there's some real power to accelerating the depreciation and reducing that taxable income.
Well, and it's something a lot of people don't even think about, right? They take their shoebox of receipts to their accountant and say, here, prepare my taxes. And they say, okay, 27 and a half years divided by, and they're done. This is kind of a proactive thing. So in order to get the benefit of cost segregation, there's a process. And we'll talk through that so that everyone understands what that looks like. And it's generally done in conjunction with an engineering firm and an accounting firm. So let's talk about why that is and how it works.
Yeah, no, that's a great point, Robert. So our CPAs, I kind of look at CPAs as general practitioners. So they've got so much that they have to know. I mean, the tax code is thousands of pages long. There's child tax credits. There's earned business income. I mean, we just focus on cost segregation. And so you've got to have, in order to complete a study, you've got to have constructional engineers to be able to go in and basically reverse engineer these buildings. And then you also have to have the tax knowledge. And so that's where most CPA firms will partner with a cost segregation company to be able to offer that to their clients, because most CPA firms typically don't have a constructional engineer on staff. And so in order for them to be able to put these numbers together and put values and know what type of plumbing is used behind the walls, like I said, your typical CPA doesn't have that knowledge. They definitely have the tax knowledge, but the engineering-based side is really why most CPA firms will will outsource this and partner with a company to be able to provide this to their clients.
Successful real estate investors are used to working with teams. They have vendors, they have people that work together. And this is a great example of that, where the tax professional sees it from one side, the engineer sees it from another side, and they have to come together to make these decisions to come up with a report, which is basically how it works. You hire a cost segregation company, and they're going to go through and analyze the various components and kind of the age part that you talked about in terms of how long each of those assets is really viable from a tax point of view. The range is going to be dependent upon myriad things, right? So if it's a brand new property, probably easy to get with the developer, and that's maybe an easier thing to figure out what those costs are. If I'm buying a property that's 40 years old, then you've really got to kind of dig beneath the hood. So is there always a physical, in-person inspection required for a cost seg study?
There is, yeah. So that's part of what the IRS requires. So the IRS has actually put out an audit guide that most cost seg companies will follow. It's 13 steps, and one of those is it does require a site visit. So typically we'll send one of our constructional engineers out to the property for them to do an inspection of the property. And what they're looking for is they're looking for things like, is there a retaining wall outside? Is there drainage in the parking lot? What type of flooring is used? What type of window coverings? How much of each of those different components? And so they'll go through and do an inspection. That, coupled with blueprints, if they're available, and some other tools that we have, we're able to get a real good idea and put a value to all those different components of the building.
And having done a few of these and seen some of these reports, they're pretty detailed. I mean, you go into the property and you guys have a bunch of great case studies. In fact, you've written a beautiful report we're going to offer the listeners to kind of sum up many things we've talked about, but also give some examples, which I think people can really learn when they see the numbers and see the property. But there's a lot of detail that goes into this so that these various components are clearly identified.
Yeah, that's correct. Yeah, so typically these reports are anywhere from 40 to 60 pages. And again, we're going through and we're basically line iteming every component of that building. So whether it's the flooring, the cabinets, the countertops, portions of the electrical, portions of the plumbing. Again, we'll even go out and count the trees and bushes. The IRS says trees and bushes are 15-year assets. So there's no reason for us to depreciate those over 39 years. We'll put a value to those trees and bushes and depreciate those over a much shorter timeline.
Got it.
So they are very technical. It does require a certain level of expertise in order to complete these studies and do it effectively and do it according to the IRS guidelines. But again, that's why, like you said, you partner with somebody. We always partner with the CPA involved on the project. We get them on board, make sure they understand the value of it. They're privy to a lot of information that we may not be. There may be some other passive loss issues. There may be some charitable contributions we're not aware of. And so we always will partner with the client and the CPA before we ever move forward on a study, because we want this to be beneficial for everybody.
Well, and it's a big chunk of work that has to be done. And so one of the obvious things, I guess, out of the gate is at what size or level or cost of property does it make sense? Because you're going to spend some money for this study, and then you're going to have to obviously have the employment of the accountant to get involved. So what's the typical size kind of threshold before you'd even consider doing a cost seg analysis?
That's a great question, Robert. So there's a misconception out there. I'll just be quite honest with you. A lot of people think you've got to own $1 million building in order for cost segregation to be beneficial. And that was the case probably 5 to 7 years ago. So the cost of these studies, $7,000 and $15,000 to get these studies done. And so in order for you to recoup the cost of the study and save tax money, you had to have roughly $1 million building in order for that to make sense.
Okay.
With some of the recent changes to the tax laws and companies becoming more efficient and having better ways to do these studies, really, I always suggest anything over about $200,000 you should have looked at.
Okay.
And so it doesn't always mean it's going to make sense. Sometimes it may, sometimes it may not, depending on a number of variables. But you always want to have those properties analyzed to see if it makes sense. And most cost segregation companies out there will do a free benefit analysis to make sure that there is going to be significant tax savings. But I honestly nowadays tell anybody, if you've got anything, over $200,000, definitely have it looked at. I will share an example. We actually worked with a gentleman who had some tract homes in the middle of Tennessee, and he purchased 12 of them. Purchase price was somewhere between $85,000 and $115,000, but we did them together as a group, and he was able to save significant amounts of money on his taxes. And so again, those are relatively small investments in terms of being able to do cost segregation, but coupled with the new tax laws, and I know we'll touch a little bit on bonus depreciation, there's an opportunity. A $10,000 tax savings to somebody who owns a single family rental home is just as significant as a $100,000 tax savings to somebody who owns an apartment complex. And the fees are coming down and make it possible.
We say you have to do the math, and the math will tell you what to do. And the only reason you would incur an expense like this is because there's a greater benefit. And that's really almost always the case with these studies, because you're going in and you're taking a sharper look, focusing more and getting more detail. And that allows your tax professional to give you these benefits. And I know you're not necessarily a tax preparer or tax professional, although you know a lot about this business, certainly. But let's talk about what happens when somebody sells, because when you sell a depreciated property, you're going to have some recapture, perhaps, most likely. How does taking this bonus depreciation of any kind affect that?
Yeah, that's a great question, Robert. So typically when you sell a property, you have to pay two types of taxes. You pay a capital gains tax, and you pay a recapture tax on the amount of depreciation you've taken. So that's a typical real estate transaction, no cost segregation work involved. You buy a property, you sell it 5 years later, you have a gain on it, you pay those two taxes.
Yep.
With cost segregation, we are able to allocate the sales price to the right buckets. And I don't want to go too far into the weeds here, but basically what you're doing, and we get this question all the time, why would I want to accelerate that depreciation? Because I'm going to sell this building in 5 years. Don't I have to just pay it all back? And there's a couple reasons why you do. One is there's a rate arbitrage. So the idea is you take the deductions at a high rate today and you pay them back 5 years when you sell at a lower rate. Sometimes that rate difference can be anywhere from 10 to 15%. So that's a 10 or 15% permanent tax savings that you keep in your pocket.
Got it.
You also have a time value of money aspect where you take your deductions today, even if you do have to pay them back dollar for dollar at the same rate, you're basically getting an interest-free loan from the government that you can then go and invest, buy new properties. But the third one, and most important, is let's say I buy a property today, I do a cost seg study, we identify that there's $100,000 worth of 5-year assets. If I own that building for 5 years before I sell, those 5-year assets have become fully depreciated with a $0 book value. They're worth $0. And you think about that, makes sense. If we use an example of carpet per se, the IRS says carpet lasts 5 years. So if I bought my building in 14, sold it in 19, I've fully depreciated that carpet. And the way that recapture works, it says you have to pay recapture on the amount of depreciation you've taken or the gain on the sell, whichever's less. And so think about that. What is the gain on your sell of carpet? I've owned this carpet for 5 years. My building went up in value, but did my carpet really go up in value?
Probably not.
Probably not. It's stained, it's dirty, it's 5 years old. And so what happens when you don't do cost segregation is you basically say, I bought a building for $1 million. I sold it 5 years later for $2 million. You're saying that the land, the walls, and all the personal property inside went up by $1 million, including that dirty carpet. And that's just not the case. And so by doing a cost seg study, it allows you to manage the sales price and allocate that to the right buckets. So when you do sell it for $1 million more, you can say, that $1 million is going to the land and the structure, not my carpet and countertops. Again, that's kind of a complex issue that we oftentimes will even teach CPAs on how to look at that. But the whole idea, and for the listeners today to remember, is you're not going to sell your carpet today for more than you bought it for 5 years ago. And that's really the easiest way to look at it.
We're talking about increasing cash flow and reducing taxes with cost segregation. Eric Oliver is our guest. When we return, we'll find out more details about how to take the most advantage of this. We'll also let you know how you can get Eric's free report, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
When the world changes, investing strategy changes too. The coronavirus is disrupting economies, financial systems, and daily life like nothing in modern history. Sheltering in place might protect you from the virus, but a wait-and-see approach to investing now is like pulling the sheets over your head while the house burns down. It's not the time to be complacent. So we're calling our huge network of thought leaders, seasoned investors, and technical experts to find out what they're seeing, thinking, and doing to mitigate risk and capture opportunity, and we're recording all of it. We're calling it our Coronavirus Crisis Investing Webinar, and it's totally free. All you need to do is register. Remember, mainstream media doesn't talk to real estate investors. They don't understand you because Wall Street pays them not to. That's why the real estate guys are here. To register for the Crisis Investing Webinar, simply send an email to crisis@realestateguysradio.com. That's crisis@realestateguysradio.com. Real world wisdom is the best vaccine for a healthy financial future. Send your email to crisis@realestateguysradio.com.
Hey, it's Gene from the Residential Assisted Living Academy. The silver tsunami of seniors is coming. You've been hearing me tell you about that for years now on the Real Estate Guys, and it's true. You know, with everything that's going on in our world today, the safest place for a senior to be is a residential assisted living facility. The best place to be for cash flowing real estate in the current economy is residential assisted living. You know, I've been telling you about it. The silver tsunami is here. But if you'd like to learn more, be educated, and get the information that can really propel you into the future, I'd love to share that with you.
To gain access to an informational webinar presented by certified financial planner and real estate entrepreneur Gene Garino, and discover how you can turn a nice home in a nice neighborhood into a cash flow machine, send an email to ALF, ALF at realestateguysradio.com. That's ALF at realestateguysradio.com.
Hey, I'm Jim Grant. I'm the editor and indeed the founder of Grant's Interest Rate Observer. And you, ladies and gentlemen, you lucky people, are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, if you ever want to do bigger deals using other people's money, then come on out to the Secrets of Successful Syndication, our 2-day course on putting together real estate funds and group investments. It happens the last weekend of September, either live in Dallas, Texas, or virtually, depending on where the world is. And you can get all the details on our website at realestateguysradio.com under events. We're talking with Eric Oliver today about increasing cash flow and reducing taxes through cost segregation. Before we get back to that conversation, it's time to play Real Estate Trivia. Your chance to win a prize by knowing today's real estate trivia question. When you hear the question and think you know the answer, just fire off your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. The first person that gets the right answer will get an awesome book called Resilience, Turning Your Setback into a Comeback, a collection of amazing stories put together by a good friend, Kyle Wilson. That can be yours if you know today's real estate trivia question. Last week we had one from the archives with the godfather of real estate, Bob Helms, and we asked this. Bob was raised in his early years in a tiny town named Binger, Oklahoma. What famous Major League Baseball player also hails from Binger? Well, the answer is Hall of Famer Johnny Bench. Johnny Bench, of course, played catcher for the Cincinnati Reds from 1967 to 1983. A long career in the major leagues, and Bob's aunt used to babysit him. Here's our real estate trivia question for this week. India is the most vegetarian country in the world, with approximately 38% of the population eating no meat. Which country's number 2? Yeah, on a list of the top vegetarian countries, India's number 1 by a lot. What country's number 2? If you know or just want to take a guess, send your best guess to trivia@realestateguysradio.com. Include your name, the answer to the question, and your physical mailing address so that if you're the winner, we can send you Resilience, turning your setback into a comeback. That's today's real estate trivia question. We're talking about one of the 4 ways we make money in real estate, and that is through tax savings, tax incentives, tax benefits. And one of the unique ones is this idea of doing a cost segregation analysis, where we look at the property and say, okay, it doesn't all depreciate over the same amount of time. Some wears out sooner, some is worth less faster. And that's a pretty big problem to solve, and that's why companies like Eric's take this job on. And I think one of the things we should point out is that this is something you can't do on your own. It's not, people say, don't try this at home. Literally, people aren't qualified to do this work on their own.
Yeah, no, that's exactly right. So one of the first things that the IRS audit guide states is that this has to be completed by a person with experience in both taxation and construction knowledge. So it does state that it has to be done too by a third party. So it would be very difficult, and I wouldn't suggest anyone taking this on themselves because it would be tough to hold up in an audit when you do it yourself.
Now, for a lot of years, I taught appraisal, and we have the concept of depreciation in appraisal, but it's not the same as tax depreciation. It's based on the same thing, but the idea of depreciation is those improvements wear out over time. I buy a property, and 80 years later, it's not worth anything. Now, we know, because we've seen property in New York and San Francisco and Los Angeles, that properties that are 80 years old can sell for a lot more than people bought them for then. So the depreciation from an appraisal perspective is the idea that components of the property wear out over time. The tax side is the same idea. It's just crammed into what the government decides are the amounts of time. And it wasn't always 39 years and 27 and a half years. It's been that for a long time. But over the history of the tax code, we've seen those amounts change. And this brings up a topic I wanted to ask you about, Eric, and that is, if I have never heard about cost segregation, and I've been filing my taxes for the last 3 or 4 years on all my income property, is it too late? Is there a way to go back? And when can I do cost segregation?
Yeah, you can do cost segregation at any point that you own the property. So as long as you still have ownership of the property, let's say you bought it in 14 and you've been taking your standard deduction for the last 5-6 years, you can still do cost segregation in the current year. And actually, you get to go back and take that, what we call missed depreciation or catch-up depreciation. You get to take that the current year. And the IRS has given us some great tools where you don't even have to amend your tax return. There's a tax form. It's the 3115 tax form. But basically what that form says is it lets the IRS know. It says, hey, IRS, I bought this property in 14. I've taken my straight line depreciation. I'm now going to change the way I depreciate that property. And I'm going to accelerate that depreciation. And here's the difference. And there'll be a number that we come up with. And that number can be taken against your current tax return. And so it's a great opportunity, especially on some of the smaller properties that may not typically qualify for cost segregation. If you owned a single family rental home for the last 7 years and you've been taking your straight line depreciation, you're going to have 7 years of missed opportunity or missed depreciation that you can drop on your current tax return. And so that's why, I know I touched on, but it's always important to get these looked at because there's a number of variables that will determine whether or not it makes sense or not. But the IRS does allow you to go back and do these look back studies. So it's a great opportunity. If you're paying taxes and you own real estate, you definitely want to have your properties looked at.
Eric, you talked about this idea of doing an analysis to see does it make any sense. How does that process work? If I'm not sure if I'm right on the edge of either the size of my building or how it's built, what it's built out of, I imagine industrial might be different than residential. Tell us how that process works.
Yeah, so we can run a benefit analysis. We've got some tools based on historical data where we can get a few pieces of information from you and determine what the accelerated depreciation is going to look like. So typically, we just need to know the address, the purchase date, or I should say the in-service date, the type of asset, whether, like you said, it's a residential building or it's a medical office, and then the purchase price. Or if you've got the depreciable basis from a tax return, that's even better. And then what we provide is a detailed benefit analysis that says, on this property, we anticipate increasing depreciation in the first year by X amount of dollars, and here's the fee to do that study. And then typically we can get together on the phone with the CPA and say, okay, we've got this depreciation available to us. Can we use that depreciation? What are the different tax rates that we're involved in? And what is the actual savings to the client going to look like? And so typically, Robert, we like to see somewhere between a 7 to 10 times return on their investment with us. So if we're going to charge you $3,000 for a study, we want you to save somewhere around $30,000 on your taxes. And if you're not going to, you never have to engage with us, which is great. Like you said earlier, it's just a numbers game. So that's why we run the numbers. It either makes sense or it doesn't. If it makes sense and you're going to save tax dollars, then you move forward. If it doesn't make sense and you're not going to save tax dollars, then you hold on to it. Doesn't mean it's never going to make sense, but you just hold it in your back pocket. And maybe when your situation changes or you've got more income coming in or whatever the situation may be, you've got that in your back pocket. And that's when you pull that card and play that card.
Yeah, that's a great point. We talk about, say, insurance, which is a necessary expense, and it's the one thing we pay for. We hope we never have to use. But with cost segregation, you don't want to just get a dollar for dollar return on the expense. You want to make sure it's a multitude. I'm glad you're minded that way, because certainly the client would be thinking that way. Every year, the tax code in the United States, and I imagine many places, changes a little. A couple of years ago, we had massive change. And talk a little bit, if you will, about how cost segregation overlays with the bonus depreciation.
Yeah, definitely. So as most of us are aware, in the end of 2017, 2018, there was a big tax overhaul. And again, as most of us are aware, our current sitting president owns quite a bit of real estate. And so there was a lot of very favorable provisions in that tax law for real estate investors. And one of the most favorable, like you mentioned, was this bonus depreciation. And so basically, bonus depreciation, it's been around for a number of years. The government each year, they would change the amount of bonus depreciation that you were eligible for based on how the economy was doing and what they were trying to accomplish. But prior to the 2017 Tax Cuts and Jobs Act, if you were to build a new building and have a cost seg study done, any of the 5, 7, and 15-year assets were eligible for bonus depreciation. Let me just take a step back, Robert. But basically, bonus depreciation, there were a few requirements in order to take bonus depreciation. One is the asset has to have a 20-year depreciable life or less. And the second is it has to be new. Those were the two provisions under the old tax law.
Yep.
So oftentimes people say, well, how does this apply to real estate? My real estate is a 27.5-year asset or a 39-year asset. Well, it is at first, but if you do a cost seg study, all of a sudden we've identified those 5, 7, and 15-year components, which now are eligible under the tax law for bonus depreciation. So under the old tax law, you would get a 50% bonus on any of those 5, 7, or 15-year assets. And what that means is if you had $100,000 worth of 5-year assets in your building, you could take $50,000 or 50% of that in the first year. The remaining 50% would be depreciated over 5 years or 7 years or 15 years respectively.
Okay.
And so it was a great opportunity. It was a great way for the government to incentivize people to go out and build a new building because you could accelerate that depreciation even faster.
Sure.
So with the changes to the tax law, two big things happened. The first one is it no longer had to be new. And what I mean by that, Robert, is I can go out and buy a building today that was built in 1970, and it would be eligible for bonus depreciation. I no longer has to be new construction.
Okay.
And so that was a big change. The second big change was it's no longer 50%, it's now 100%.
Wow.
And I just want that to sink in for a minute. So if you think about it, I'll just give you a quick example, Robert, of $1 million building. You have $1 million building, you do a cost seg study. We typically segregate, like I said, somewhere around 30%. So you have $300,000 worth of 5, 7, and 15-year assets. If I'm able to take 100% bonus on those 5, 7, and 15-year assets, all of a sudden I've got a $300,000 depreciation expense that I can use in the first year. And so, you think about what your down payment, there's all kinds of things you can do with a $300,000 depreciation expense, and that's on $1 million building. With the changes to the bonus depreciation, we're creating deductions that people may not even be able to fully use. And so there's some tools that you can manage those deductions, but great opportunity. The bonus depreciation, anything purchased after September 27th of 2017 through December 31st of 2022 is eligible for 100% bonus depreciation.
All right, good stuff. Well, this has been an excellent primer on what cost segregation is, and obviously you're in the thick of getting this done. Eric's put together a really cool report that covers not only what we've talked about in terms of the details and kinds of explains a bunch of the benefits of doing it, but also some case studies where you can look at some different properties and get your eyes around the numbers, if you will. So that's helpful. I think just from an educational viewpoint, I think that's great. When we come back, we'll tell you how you can get a copy of Eric's report. Hey, last question, Eric. How long does this take to do? You know, we're coming up on tax season, and this particular year there's been an extension, but you've got to work with your accounting professional. They're busy. From the time I say, hey, Eric, I'd love to have you guys do a study on my building, what typically is the timeline look like?
Yeah, so the typical timeline that we shoot for is 30 to 40 days after we're engaged. And so a good portion of that 30 or 40 days is setting up that site visit that we talked about, you know, booking travel and that kind of thing. So we can shorten that a bit during crunch time, but typically around 30 to 40 days, that gives us time to do the site visit, you know, a couple weeks to schedule the site visit, a couple weeks to write the report, and then gather whatever information we need from you, the client. So that's kind of what we're shooting for. So still plenty of time to do it on your 2019 taxes. Those technically aren't due until October 15th. So if you file an extension and you find yourself with a tax liability, you can still do a cost seg study today to help offset tax liability for your 19 tax return.
All right. Good stuff. Well, hey, thanks so much for sharing. This has been great. Glad to hear this information, and we'll look forward to seeing you when we can do that once again.
Sounds good. Thanks, Robert.
All right. There's Eric Oliver. We'll come back and tell you how you can get a copy of his great report. We've got more coming up. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Don't be like Charlie, who scans the internet for IRA information, often getting bad information from copycats who have no idea what they're doing. You deserve to work with a reputable firm that specializes in one thing, the EQRP. Lucky for you, Congress just made it possible for you to get up to $200,000 out of your current 401k or TSP, so you can invest that money in real estate or even your own business. Even if you're still working, it's possible to get access to all this money tax-free. Whether you're a full-time investor, a doctor, or a government employee, even if you have employees, the EQRP is your secret weapon. You'll never see this strategy in Money Magazine, only here with the Real Estate Guys. Every major accounting firm in America is quietly sharing this strategy with their wealthy clients, helping them get their funds freed from 401k jail. Hi, I'm Damian Lupo, and we have your solution. With the CARES Act expiring soon, this strategy will be gone forever. The EQRP company is ready to help you unleash your retirement funds now. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report today.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Tell a friend about the Real Estate Guys. If you've ever thought about doing bigger deals using other people's money or passively investing in bigger deals, come on out to the Secrets of Successful Syndication, where you can learn about fund investing. That happens the last weekend of September in Dallas, Texas, or a computer screen near you. Get all the details at realestateguysradio.com. Well, I don't know about you, Russ, but I learned a lot from Eric about cost segregation.
Yeah, absolutely. You know, I think one of the things that was really great about the way he presented the material, which can often be very dry, very esoteric, extremely confusing, is he would explain the concept, he would keep it simple, then he broke it down and gave some, math and just explained. And I think there were so many things that came out of it that were great, but I think the big thing is you can go back and grab what you've missed and bring it into the present. That's awesome. Number two is that it really is something that even a moderate-sized portfolio holder ought to take a look at, and I think that's exciting. And that there's still some time really to take advantage of the bonus side, because you've got properties you can pick up over the next year or two and gain that advantage. And again, I go back to what I said at the top of the show. When you can change your cash flow substantially in an acquisition year on a property without having to use, resources from elsewhere, In other words, if you're going to have to pay tax anyway on things that you have happening in your portfolio and you suddenly have that money available to you, yes, technically it's your money. I always bristle when somebody says, Uncle Sam's going to pay for it. No, they're not. What they're going to do is they're just going to take their claws off of your money and let you use more of your money longer. But that can really, really help on the cash flow side of things, which means you can tend to be a little bit more aggressive in going after some properties that you might not have otherwise gone for because you felt like, hey, I don't quite have the reserves or the capital available. So it's a fantastic tool to enhance cash flow in those early years. And I think, to me, that's the thing that gets me the most excited.
The whole part about landscaping, it never occurred to me. Most of the properties that I've had this done on, there hasn't been a big landscaping component. But if you have that, you can actually depreciate those assets faster. Apparently, if I did the math in my head right, $1 of tax deduction in the house is worth $2 in the bush.
Nice.
Anyway, there's a lot to learn about this. If you'd like to get a copy of Eric's report, it's actually put together in a very beautiful manner as well. All you have to do is send an email to CostSeg, COSTSEG, CostSeg. I guess we could make it cost segregation, but why do all that typing? CostSeg at realestateguysradio.com. And he's got some examples in there. And then you'll be able, of course, get his contact details if you're interested in talking about getting this kind of thing done. I love the fact you can go back and do it proactively. Not a super sexy, sizzling topic, but one we've been wanting to talk about for a long time. And I'm glad we're able to do that today. So big thanks to Eric for sharing his time and expertise with us today. Got another great show for you next week. If you've not yet signed up for the Crisis webinar, you can still do that. Just send an email to crisis@realestateguysradio.com. It's a behemoth webinar with some of the smartest people we know talking about what to do in the wake of this huge change we've seen in 2020. And you're going to dig it. It's also 100% free. Just send an email to crisis@realestateguysradio.com. Until next week, go out or stay home and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.